Hi, this is Jay Hummel. Welcome to the Deep Dive. Excited to have a really interesting topic today. We get a lot of requests from advisors about what's going on in the real estate space, and I can't think of a better person to have on the show today than the CEO, chairman, and founder of Forum out of Denver, Colorado, Darren Fisk, who's a good friend of mine. I'm proud to be on their board, two of their fund boards. So Darren, welcome to the show. I know you're extremely busy. Appreciate you taking the time and just give the viewers a little bit of background about you and about Forum.
Sure. Thanks for having me, Jay. I know everybody's busy these days. It's kind of a common theme. Just a little background. Started, here in Denver, Colorado after going to school in Boulder, played football, and just figured I'd stay around this area, just having known a lot of the folks in the, environment, the Denver kind of metro. But started Forum really about 20 years ago after having my first kind of career in the real estate finance business. So learned a lot about how real estate, went together, just looking at financials and financing projects all around the United States, primarily in multifamily, but did some stuff on the commercial side as well. But Forum, we have almost a 19-year history now. We're a boutique multifamily owner-operator, been in approximately 25 states, invested over $6.5 billion, and that's across acquisitions, development, and lending, with our primary focus really being, multifamily real estate. And last, Jay, I'll just kind of tell you, through those real estate finance opportunities, it really helped shape the way that I invest, saw the good and the bad. But our focus at Forum is really opportunistic investing. So we originate over 80% of our own opportunities in-house. And people say, well, how do you do that? What's your secret sauce? Being a developer, being an acquirer, but even as important as being a lender. Folks might come to saying, hey, we need a loan, and then it ends up becoming a joint venture, if you will. So there are a lot of outside firms that come to us trying to allocate capital because they're not able to get kind of our middle market, niche across all these things. It's been very rewarding. Nothing's easy. It sounds easy. It's a grind like everything else. And 20 years in, I feel like, some days we're still a startup as the market evolves so quickly.
Yeah, and Darren, when you think, because real estate's such a broad category, right? When advisors, because again, advisors watch this show. When you think of the broad category of real estate, people tend to think commercial, retail, multifamily, residential. How did you choose, as it relates to your career and also as you run Forum, how did you decide multifamily made sense for you?
Sometimes in life people gravitate towards certain things. So when I first started off in the real estate finance business, I really started gravitating towards multifamily housing. And I think looking back, why was that? I grew up in a small town, 30,000 people in the Bay Area. It was all about community. My dad was a school principal, mom was an interior decorator. So they'd buy single family homes and duplexes. So we'd fix those up and we got to know our residents, like personally. And so I really just gravitated towards multifamily housing. That said, it was actually a lot easier to finance multifamily because we had twice as many lenders for residential multifamily than you do for commercial, like hotels, and retail and office and industrial. So just kind of those things converging that made it easier. People have to have a roof over their head or they're homeless. And as we've seen through COVID and what have you, you can shop from home, you can work from home, but you always had to have a home, as I say, or you're homeless. So that's really kind of those forcing functions and my passion. I did some retail development and I did it for the wrong reasons, candidly. I was doing it. My father-in-law was a retail developer and it was because I could just make money at it. And so I'm glad I did it, but I kind of came back, to what my niche, really was and always has been. And so we haven't, unless it's really multifamily driven with some retail, we just don't do other asset classes.
Well, in the multifamily space, when you think, and I'm going to pick 3 years. You may say 1 year, 2 years, 3 years. You pick the future timeline that you want to pick. How do you see, because you live it every day, right?
Every day.
Like if you're in the multifamily space today, how do you see the outlook of, as an advisor, thinking about putting their clients into the space? How do you see the space moving over the time frame that you want to choose?
Yeah, so I'm just going to maybe go back a little bit in time, and this is really crucial to understand kind of some of these anecdotes that are happening. We obviously are coming after coming through a 30-year high in multifamily deliveries at the end of 2024. So a lot of the developments that were started, and I'm going to use development example over the last 5 years, nobody really was predicting higher interest rates, both for construction and when you get a takeout loan on the permanent rate, which would be the 10-year treasury. So
Sure.
what's happened is we've gone through this 30-year, all-time high in, say, Q4 of 2024 of deliveries, followed by the least new construction starts that we've seen in 30 years. You guys read the headlines, single family, out there, a lot of the single family home builders were buying the interest rates down from, say, a 7 to a 5. And they're spending $40,000 to $70,000 per home, and the consumer is fatigued. So you have all of these forcing functions again coming where you had all this supply. And even I understood the supply wave. We're a developer. We're also an acquirer, as I mentioned, but we haven't bought anything in 5.5 years. So that kind of should say a lot to you where we saw the acquisition market. We were getting equity returns in debt and credit. So the one thing that I didn't anticipate, and a lot of people haven't been thinking about, is one thing is the supply, and when we peaked, Q4 2024, the other is the lease up. Once something's complete, you then need 12 to 18 months to lease it up. So what's happened to a lot of owners because of this oversupply is they've had to give a month free or 2 months free or 3 months free. Couple that on top of higher interest rates, as we mentioned, a lot of construction budgets were blown, as you know. So all of a sudden you have these owners and developers saying, hey, my loan's due and it's time to rebalance it or pay it off. And they may or may not have the capital in which to do so. So that's where people are coming to groups like Forum saying, hey, we need a partner, whether it's a loan, a recap. But what's happening, Jay, is the unintended consequences of dropping your rental rates a month, 2, 3 free means that your net operating income is going to be off by a third, a half, which means your value and your equity is going to be off by whatever that exponential amount is. So you have this huge impairment of equity value in all these properties. What do owners and developers not want people knowing? They don't want them to know that there's problem with what's going on in their portfolio. They want anonymity. And so all these things are happening where folks coming to us, and I have not seen a buying opportunity to go buy brand new, nice stuff like we're seeing today. After the GFC hit in '08, you could buy anything anywhere because everybody was in trouble and you didn't have all the new building and oversupply. Today, it's different. Today, you actually have somewhat strong cash flows, but you can go buy brand new assets at a significant discount to replacement cost. So unless you're finding those most exclusive developments, you're probably not going to be developing a ton, but you can go buy. So everybody a year ago, I say everybody, we weren't in this camp, said, hey, interest rates are coming down, survive through 25. Well, now it's becoming, hey, the fix is in 26, and it's going to be heaven in 27, and it's going to be great in 28. It's just all this, BS that people are coming up with. And so if you're an opportunistic investor and you're not an allocator, and that's a huge difference. We're not an allocator of capital. We're very opportunistic when we invest up and down the capital stack. We now are pivoting back in to take advantage of these opportunities to go buy things from stressed or distressed sellers. The property themselves are not distressed. It's the capital stack. So that's a long-winded way of saying I haven't seen an opportunity like this in 30 years.
No, I think that's a great answer. And I think that leads, to, we could talk about this forever because I love having you on the show. One of the questions I always ask is kind of my last two questions is one is if you were an advisor today giving advice to a client in the real estate space, what would you tell them? And two, what do you think that people aren't talking enough about? And it may be real estate global, it may just be in multifamily. What do you think the one thing advisors need to look out for from a risk standpoint?
I think there are quite a few, but number one is chasing yield without understanding risk, right? A lot of investors, advisors get enamored with high projected IRR, cash on cash returns, and they don't really understand the risk associated with those. Not underwriting who your operator or sponsor is,
Yeah, I
like
get
a
it. Yeah,
forum,
I
right?
get a 12 cash yield, but my equity value is zero when we
Right,
get to the bottom.
right.
It's
And
like
and maybe
that's not a
third
win.
is and I'm a recovering lender, I'm a debt guy, but over leveraging or using the wrong type of debt. So like in our big equity vehicle at Forum, everything we have is fixed rate debt. And again, I learned that. I never was trying. That's one. I want another thing I can take out of the volatility equation, and that's debt. If I've got fixed rate debt, it's not volatile. If I've got floating rate debt, it's very volatile. So, you know, understanding an investor or an operator like ours track record, not chasing IRR. And then last and probably as important is the debt, right? So many people focus, and there's one thing people took away from this podcast as they think about investing with anybody. Ask a simple question, not what is a company or in a specific deal or funds loan to value, what is their debt service coverage ratio? You don't get hurt by loan to value. You get hurt by a lack of debt service coverage ratio. And debt service
That's
coverage
right.
ratio is the number or the percentage that your net operating income would cover your debt. So Fannie and Freddie might underwrite a loan to a 120 or a 125. That's, 1-1, you're breaking even. Our portfolio, we always look to be north of a 2.0. I think right now we're at like a 2.2 or 2.25. So I feel really good about debt service coverage. I could have an 80% loan to value and a 2.20 debt service coverage. Great. Haven't seen that in probably 10 years. Today, it's really more, again, it always has been about debt service coverage, not loan to value.
If people want to do business with Forum, how do they find you? How do they find your team watching the show? How do they get in touch with you?
Yeah, so we almost exclusively work with advisors and family offices. Our website, forumig.com. I'm D Fisk, Fisk at forumig.com. One promise we have to advisors is you always get access to me as the CEO, our portfolio managers, our CIO. So, we're open to creating real meaningful relationships. So I'd love to have the discussion if you're looking, to get into the multifamily, real estate or investment management space.
Well, Darren, thanks again for taking the time, man. It was great seeing you, and hopefully you'll come back on the show in the future. And I would encourage people to reach out to Darren. They do some great things at Forum.
Thanks, Jay. Appreciate it.
Yeah. All right. Thanks for watching today. We'll see you next time on the Deep Dive.